Today we will talk about debt mutual funds, the risks involved in debt mutual funds and the process we at EA Capital follow to invest in debt mutual funds. Everyone wants high fixed returns, for which they look at debt funds as an option, but most people are not aware of the inherent risks in debt mutual funds. People assume debt mutual funds to be safer and less volatile than equity funds, but if not chosen wisely, debt funds can be riskier than equity funds. So without any further delay, let's look at the various types of risks that you should be aware of before investing in debt funds, and the process we follow before selecting debt mutual funds for our investments. So, first of all, let's discuss the main risks inherent in debt mutual funds. Credit risk. The first and foremost risk when you invest in a debt fund is the credit risk. Credit risk is simply the risk which comes with the possibility that the person or the company who has taken your money as a loan may not be able to service that loan and may default when the due date comes. So before making any investment in a debt fund, you should always look at the inherent credit quality of the debentures or the bonds, or the debt mutual fund at large, where your money is getting invested. Typically, we are EA Capital, only invest in AAA-rated bonds, debentures and debt funds, because that offers us the highest level of safety of principal, even though the coupon rate or the annual yield in AAA-rated bonds or funds may be lower than a single A or lower-rated bonds. We feel it is wiser to focus on conserving capital while investing in debt instead of chasing higher returns by investing in lower credit quality and hence not very financially strong companies. Interest rate risk. The second most important risk in a debt fund is the interest rate risk. Interest rate risk is simply the volatility in NAV which will come in our debt mutual fund portfolio because of the daily interest rate movements. For example, if we have invested in a 5-year maturity debt mutual fund and there are 4 years left to maturity of the fund. Let's assume that we do not intend to wait till the maturity of that debt fund and we wish to liquidate this debt fund today itself, which is 4 years before maturity of the fund. Now, assuming that during the period of our investment in this debt fund, the interest rates have gone up, then obviously the debt fund which we are holding will be a lot lesser in value because any investor can now buy a higher interest yielding debt fund from the market. So to compensate the buyer, so that she gets the same yield from our debt fund, that she could get by investing in a fresh debt fund directly from the market, we will have to sell our debt fund at a discount. So, if the interest rates go higher during our period of investment in debt fund and there is significant amount of time left to maturity, then we will have to sell our debt fund at a discount. On the contrary, if the interest rates go lower during our period of investment, and there is a significant amount of time left for maturity, then we can sell our debt fund at a premium. So when we are investing in a debt fund, returns are generated from addition of capital gains or losses because of interest rate movement and interest payments. We at EA Capital always match the average maturity of the debt mutual fund portfolio with our financial goals. For example, if we are investing in a debt mutual fund to accumulate funds for a property purchase due after 3 years, then we look for a AAA credit quality debt fund, which is having an average maturity profile somewhere closer to 3. Liquidity risk. The third type of risk is the liquidity risk. Liquidity risk is simply the risk that when we want to liquidate our debt portfolio, there may not be sufficient buyers for our portfolio and we may be forced to sell at a price much below fair value because we desperately need to redeem the run. In fact, in early 2020, we saw one of the mutual fund companies in India had to freeze all redemption transactions because of this risk only, when the investors simply could not withdraw their money just because there was not enough liquidity for these bonds in the debt fund. This kind of risk can be negated by investing in highly liquid AAA-rated debt funds. Reinvestment risk. The fourth risk while investing in a debt fund is the reinvestment risk. The reinvestment risk is a crucial consideration and hence all the more important for investors to match your financial goals with the maturity profile of the debt fund. For example, assume that there is a goal of your child's marriage after 5 years but you invested in a 2-year average maturity debt fund thinking that it was offering higher returns compared to a 5-year maturity debt fund. Now after 2 years the debt fund portfolio matures and now during this time the interest rates may have gone down. Because of this, after 2 years, the fund manager will obviously be constrained to make the reinvestment of your money at a lower interest rate which is now prevailing in the market. Hence, because of the reinvestment at lower interest rates for the remaining period, you may fall short of the required corpus that was initially calculated by you to be accumulated in 5 years for your financial goal. So reinvestment risk is a very important risk which all investors in debt funds must always be aware of. Investors would be well served if they always match maturity of the debt fund portfolio with their investment horizon. At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel. Process we at EA Capital follow to invest in debt funds. Now that we are aware of the major kind of risks which are inherent in debt funds, we will share the process that we at EA Capital follow to make our own investments in debt funds. Step 1. Check credit quality. We, at EA Capital, do not chase the highest returns when investing in debt funds, but go for optimum returns with highest level of safety instead. To earn high returns, we look to invest in well-researched equity funds. For debt fund investing, we simply focus on the safety of capital, after that comes the returns. Hence, typically, we invest in AAA-rated debt portfolio, sovereign government bonds or state government bonds where the risk of default is very, very low. Step 2. Match our investment horizon with maturity profile of the shortlisted debt funds. After shortlisting funds with highest credit quality, we match our investment horizon with debt funds with similar maturity profile. For example, if our investment horizon is 4 years, we feel comfortable shortlisting debt funds with maturity profile ranging between 3.5 to 4.5 years. Step 3. Choose fund with highest post-expense net annual yield. Finally, after ensuring highest credit quality in matching debt fund maturity with our investment horizon, we simply choose the fund offering the highest net annual yield. The net yield is gross yield to maturity minus the total expense ratio. Please note that investors should always consider the net annual yield, which is post-expense yield, when making investment in debt funds. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you.